So the new guy gets the fun section. I get to play devil's advocate. So, what are some of the risks? What concerns us? What's the risk to the outlook? What's the risk to the market? What keeps me up at night as the portfolio strategist other than my 16-month-old son? There's some things out there that we need to be cognizant of. So long term, we feel good about equities. We're really always going to feel good about equities as a long-term investment. But looking at the current market, looking at policy, what are some things that we need to consider and be cognizant of to help us prudently manage risk in our portfolios? So the first one, first and foremost, we've talked a lot about policy. If any of these changes are less bold, or not successful, or at least take some time to enact. I know the new Secretary of Treasury, he's been out there saying we're going to get corporate tax rates cut by August. He's putting a bullseye out there. There's a ticking time bomb really for corporate tax rates. This is something we need to be cognizant of. If it gets delayed into 2018, any of these major policies, be it corporate tax rates, be it deregulation, be it infrastructure spending, that has the potential to spook the market, and we may see a minor correction. Fundamentals still seem strong, but a lot is riding on these policies right now. These next couple ones, these are all kind of interrelated. So let's say he is successful. Let's say we do get $1 trillion fiscal bill passed through Congress this year. Let's say we start to see inflation rising. Right now, the numbers came out this morning. The Fed's preferred measure of inflation is right under 2%, which is their target. If we start to see inflation rising above expectations, that has the potential to impact the market in a negative way. With that said, if inflation's rising higher than expected, you could see the Fed tighten interest rates more than expected. Just this week, you saw the odds of a Fed rate hike go from near 30% to almost 80%. And that's with two Fed presidents from San Francisco and the New York Bank coming out this week saying that a March hike is on the table. So something we need to be cognizant of. The Fed expects to raise rates 3 times this year, and we'll get into that more in the next couple of slides. The market was expecting 2. Now we're starting to see market expectations and Fed expectations converge. And with that, if you do see rates rise faster than expected, you could see a stronger dollar. The dollar's had a pretty good run relative to major currencies. And if the dollar increases too much, what is that going to impact? That's going to impact multinationals who do a majority of their business overseas. Is that going to help? It's going to help small and mid-cap stocks. So risk to the market may not be a risk to our outlook if we're overweighting small and mid-cap stocks, as Ryan alluded to before. These last few, this is more looking at global markets, right? I like to call this the exit mishmash. We've got Greece, we've got France, we've got Netherlands, we've got Italy. There's a lot of political uncertainty over there in Europe this year. We can't really expect the same outcome from what we saw last year with Brexit, with a sharp sell-off and then a sharp recovery. It may not happen like that all the time. So we need to be cognizant of the potential for some of these major countries to leave the European Union. We don't think it's a likelihood, and we try to assess the probability, but we need to be cognizant of this risk and the impact it may have on the market. And with that said, the last one is something that we really can't plan for. This is the black swan event. This is global geopolitical instability. This is ISIS. A tweet comes out one morning, it could potentially start World War III. That's my running joke with investors. You never know what you're going to get every morning when you wake up with Twitter. But again, something we need to be cognizant of. And when we think about what are the risks to the market, what are the risks to the outlook, these are some of the things that we're considering. Looking out right now, there does seem to be some complacency. So, we showed that chart of bond funds taking in more assets than equity funds. We are starting to see somewhat of a rotation. Volatility right now is low. This looks at the European stock market. If you layered on the S&P 500, it would look very similar. So at the current levels, volatility is very low, meaning that, investors are happy. There's some complacency that we're starting to see. And that We're seeing it on the economic front. There's been a lot of positive economic fundamentals. We've talked about them, over the course of the past couple of years. Consumer confidence right now is at all-time highs. It's at levels we haven't seen in over 10 years. This is coming through, and that's why the market has been marching higher. Now you layer on what Trump's been talking about in terms of policies. There's a reason why the Dow is now at 21,000. It was the fastest 1,000-point increase in the Dow in history. You have the S&P hasn't declined 1% in 93 trading sessions. Layer that on with the volatility discussion. We're due, so to speak, for a pullback. And a pullback is anywhere from 5 to 10%. We've got a great slide that we'll show you later. But on average, you typically see a 10% pullback in the market. We have to be cognizant that the market keeps running higher. There might be a pause at some point in the future. How do we manage that risk? I'm just going to talk about this briefly. This is one of the nice little tools that I get to utilize. This is how I help manage risk in your portfolios and across our models. So this is something that allows me to test different scenarios, look at rising interest rates, looking at a decline in the price of oil, looking at different market drawdowns and market returns to the upside, and how does that impact our portfolio as well as the underlying positions. So we wanted to show you this just to kind of give you a look underneath the hood to say, there's a lot of different tools that we're using. It's not just looking at a 1-month return or a 6-month return. We're really doing in-depth analysis and testing it and stress testing the portfolio almost on a daily basis. So with those risks, what are we looking at in the fixed income space? We've spent a lot of time talking about what we're doing on the equity side. We've been talking about higher interest rates, and I think it's a natural. We're at the end, so to speak, of a 30-plus year bull market in bonds. We saw the 10-year Treasury yield hit 1.3% last year over the summer, and then we saw about a 100 basis point rise right around the election. So why are interest rates going up, and why do we think interest rates are going up? Well, the Federal Reserve is telling us interest rates are going up, and they're starting to move their benchmark rate. We saw the first rate hike 2 Decembers ago. We saw the second one this past December, and the expectation, at least on the Fed side, is for 3 rate hikes this year. Now it's looking more and more likely, like I said before, that we'll see one in 2 weeks. At the end of the year, the market was expecting 2 rate hikes and a slower path than what the Fed has been forecasting. Now you look at it and say, okay, inflation's right at their target. Unemployment is beyond their target. They have a lot of firepower now to raise interest rates. But it's interesting to see on this chart, looking back at 1999 and 2000, seeing how high the Fed funds rate was. And for retirees living off the portfolio, not saying that we need to get to 6%, but it would be nice to see cash rates back into more normalized levels for that safety portion of your portfolio to actually earn some money on it versus getting 0.01 or 0.1% on a money market or a very short-term CD. So beyond short-term rates, we actually think medium-term rates have the potential to go up as well, and that's just due to the size of the Fed's balance sheet. This is something that's been reported on a lot recently. The Fed's balance sheet is $4.5 trillion, and why did it grow this much? Well, that's what quantitative easing was. So Janet Yellen's been on record saying that they're going to use their benchmark rate as the tool to manage inflation. If inflation does go above expectations and we start to see potentially runaway inflation, which we think is an unlikely scenario, but if that does happen, they have a major tool to use here through selling bonds or at least letting the bonds mature off their balance sheet. That would drive up interest rates both in the medium and in the long term. So why are we concerned? Why do we have to be cognizant of rising interest rates? Well, you all might have seen this, but what this chart shows is that blue line is the 10-year Treasury yield, and we looked at the full year of 2016. I thought 2016 was a great example because we hit the all-time low over the summer. You could look at the taper tantrum back in 2013. You can layer on 1994. It all kind of works out the same. What happened here was we saw about a 100 basis point rise right around the election in the 10-year Treasury yield. And what happened at that inflection point was the red line. That's the Barclays Aggregate Bond Index that we've been talking about. It's a proxy that we use for fixed income. And you saw about a 4% decline in that index. Why that happened is something called duration. So duration is a measure of interest rate sensitivity. And the nice part about bonds is essentially a mathematical equation. It's not like the stock market where there's a little bit of hope assigned to earnings. You got to hope that, yes, the company's earning well, but the other investors see that. Bonds, it's not like that. Bonds, you tell me what the duration is, you tell me where interest rates are going, I'll tell you exactly what that investment is going to do. And that's the reason why the Barclays Aggregate Bond Index declined by 4.5%. So we've been cognizant of this relationship, this interest rate sensitivity, which is why we're positioned very defensively in fixed income. At the end of the day, in a diversified portfolio, we still believe in the number one fundamental tenet of fixed income is ultimately to provide you with a hedge to your equity exposure. That relationship has held throughout market cycles, throughout near-term market cycles and throughout long-term market cycles. So we'll always hold fixed income as the capital preservation portion of your portfolio, but we need to be cognizant of interest rate risk, especially where we believe interest rates are going up. We've hit the low. We don't think they're going down. We think that they're going up, at least over the near term and the medium term. And if fiscal policy goes through and we start to see some of these positives that Trump is trying to get through in Washington, it's only going to drive interest rates higher. But what does rising rates, what does that mean to equity? I thought this was a great little animation here, looking at Janet Yellen. I've read a lot of articles recently that say rising rates are bad for equities, and historically that's not the case. Because when you look over the past 30 years and you look at different cycles where interest rates rose anywhere from 100 to 200 to 300 basis points, you've also seen a corresponding rise in the stock market. And why is that? Well, if interest rates are going up, that means the economy is doing well. That means companies are earning more, which flows through to profits, which drives stock prices higher. So this just looks back over the past 30 years. I threw the largest increase, that 468 basis point increase that we saw from the late 70s and into the early 80s when you started to see runaway inflation. If you looked at 1994, which was the worst year for bond investors, the Barclays Aggregate Bond Index was down 2%, the S&P 500 was up 1%, and you saw about a 220 basis point rise in the 10-year yield. So for the worst year in the past 40 years for bond investors, your returns weren't that bad, and it still provided the hedge to equity when equity markets declined. So how are we positioned? We've talked a little bit about this. Per the target for each of our risk-based models, we are underweight fixed income relative to equities. And that's because we think rates are going up. We're within our designated targeted band, but we are below, we are underweight fixed income right now relative to equities, and we've shortened our duration, meaning we've lessened our interest rate sensitivity versus just the overall bond market. And the reason for that is, just like I said, we expect rates to go higher. So where is that going to hurt us? If interest rates decline, if we start retesting those lows that we saw last year, our fixed income is going to underperform the overall bond market. We think that that's an unlikely scenario for everything that we've talked about. If interest rates go higher, which is what we saw in the second half of the year, that's where we would expect our fixed income to outperform the overall market. And what we do within the fixed income space, because it's so broad, it's a $15 trillion market, at least in just the investment grade, we leverage active managers, where active managers have a staff of over 100 employees dedicated to trading. They have their own economists and their own analysts to do both credit and interest rate risk management. So that's the one area within our portfolio that we outsource because of the vastness of the fixed income market. And then we also allocate to international bonds. Our position right now is fully hedged to the US dollar, so it has a little bit of a currency play, as well as giving us added diversification beyond the US market. So that's how we're positioned right now.